All right, guys, our next big session is what are VCs looking for? We've asked Uwais Asmal, our CFO's head of advisory, to speak to some of the most amazing investors that we know. He's chatting to Rob Hersov, Hans Otterling, and Ian Lessem about that. It's a pre-recorded session just to get everyone kind of in the same one, but the best 20 minutes you'll spend. Here we go.
Hello, everyone. My name is Uwais Asmal, and I'm the Executive Head of Advisory Services at Outsource CFO. Our topic of discussion for today is what are venture capital and investment companies looking for? To discuss this, we have brought you a powerful panel with over 70 years of collective experience in the venture capital industry. My guests today are Ian Lessem, Managing Partner at Are Vcs, an investment company that specializes in early stage, high growth African businesses. My next guest is Hans Otterling, Partner at North Zone Partners. North Zone is a technology investment partnership. Some of their more noticeable investments include Spotify, Avito, iZettle, Klarna, Appin, and many more. And my final guest is Rob Hersov, entrepreneur and chairperson of Invest Africa, Africa Capital Investments, Idiotum Partners, and deputy chairman at Vistage. Let's open up the discussion with the main topic. Hans, let's start with you. What are you looking for in businesses to invest in?
So, you know, the number one is always, you know, finding a team that are having this shared vision of building something fantastic, and it has to obviously to be a tech company, right? And if we look at Africa, I think, you know, fintech is obviously one sector that is extremely interesting. Health tech is another one, telemedicine, ed tech, third one. And then everything that can, you know, enhance trade, you know, remove friction in logistics, etc. I think if I you know, look at four sectors that I think is super interesting, those four are the ones that I would look at first when it comes to Africa.
Okay, that gives us a good summary. And Rob, maybe over to you. What stage in the business life cycle are you looking to invest in, and what is your reasoning behind that?
So on a personal side, as a private investor, I do look at early stage. And what I do is, as Hans said, I look at the team, because an idea on a piece of paper 10 years later won't look anything like the idea on the piece of paper. So you want a management team that can adapt and pivot on a dime. And I'm not mad about companies that raise a fortune and throw the money in the air and hope to conquer the market. That's an American concept. I prefer building a business that will survive bubbles and crashes. And so in my private life, I invest in early stage. In my more institutional life, I putting together a fund to invest in Series A onwards. That's much more institutional, but only technology now. I have enough bricks and mortar in my portfolio.
It seems like technology is a bit of a theme. Ian, I want to get your thoughts here. Do you also focus on a particular sector like tech? Or what are you more focused on, and what's the reasoning behind that?
At Are Vcs, we invest in early stage technology companies in South Africa, East Africa, West Africa. Important for us is we only invest in companies that solve what we think are real world challenges. So quite importantly, it's got to be something that hopefully makes the world slightly better, given the pervasive challenges on the continent, and let's just say the rise of technology and the adoption thereof, and mobile penetration, et cetera. Technology can play a massive role in enabling solutions across the continent. We are quite an early stage investor by most accounts, so we post revenue seed all the way up to and including Series A. Similar to Hans, we do have a few themes, very much, as I said, real world solutions, so health tech, financial inclusion, safety tech, logistics, et cetera, things that either make people's lives better, make people's businesses better, and hopefully also helps African businesses not only attract the right talents, but also attract international clients, and you know, internationalizing their solutions.
And Hans, maybe you can just talk to us about the opportunities in Africa as opposed to the opportunities that you've been seeing in Europe. Is there a big difference Where do you see the biggest opportunities, and where are you focused on?
So I think, I'm very bullish on Africa. There are a couple of reasons. First of all, Africa has the youngest population on earth. 1.2 billion people and 60% are below 25 years old. And most of this young cohort of people, they have a mobile phone in their hand. In the next 5 to 10 years, this cohort of young people, they will change the continent. We're talking about 500 million young people, right? Massive amount of buying power, even if you look at, let's say, Africa. So I think that's a very interesting. Another very interesting thing with Africa is that if you look at an investment from our perspective, we always look at a couple of risks, right? We look at product risk. Is this product actually going to work? Is there a product market fit? We look at the market size. Is this a blue sky opportunity? Can this become a really big company? And the third thing we look at is actually team execution, right? And in Europe and US, we usually have all those three risks because we are usually investing in totally new technology, addressing a new market, and But here in Africa, you can actually take a lot of business models from Europe and US and China and Asia and implement them here in Africa. So you remove the product and market risk, and you only have the execution risk, the team, which is a considerable advantage for Africa, right? And we see so many good, interesting investment opportunities in sectors, where you have comps, other companies in either Latam or US or whatever, that you can actually kind of compare to and see, how can we build this company the smartest way, because there are other companies that done it before.
Okay, that gives us a good understanding. Excuse me. Rob, when I gave your introduction, it seems that you were involved in quite a few ventures. How do you manage all those varying responsibilities? Because you mentioned you're investing in your personal capacity and in your fund, while still giving the investee companies their due.
So first, you've got to back a great team. That's fundamental, and I've said it before, I say it again, and that's the most important thing of all. But secondly, I always do things with partners. So, Hans is one of my best friends, partner in a fund. Nick Ferguson and I are partners on an airport. And in many cases, I'm bringing the capital or the fundraising skills, the networking and top line revenue business development skills. And my partner in each case is usually bringing the other side of the equation, the sector skill or the finance or cost-based focus. And that's the only way to do it. Have a trusted partner that you worked with and an incredible team. Otherwise, there's no way to do it all on your own. But also, I silo things. So, I know where I have the greatest impact. And if I have a great partner or great management team, they know how to best use me.
Okay. So I want to switch tack a little bit. And I want to ask the question to each of you, and I'll probably start, Ian, I'll start with you first. But some people refer to certain types of business, the boring businesses. They tick along every year. They don't necessarily shoot the lights out, but they're consistently profitable. Do you only look at unicorns and 10x companies, or is there space in your portfolio for the boring businesses? Ian, give your thoughts, please.
Yeah, I wouldn't want to talk too much about the word boring. I mean, there's different types of businesses that can give different types of returns and have different types of risk weightings behind them. So there's certainly nothing wrong with a business that provides stable cash flow, adds taxes to the economy, provides employment, etc. So I think the boring is not a great word. I think that there's different places for different types of businesses. On our side, we are a venture fund. So inherent to our business is to take on a little bit of risk. And in taking on that risk, our investors need to be compensated for that risk. So we are looking for what you would call your alpha returns. We as a fund, we don't focus on the word unicorn. We really look for what we think are real world scalable businesses. So the scalability for us is super important. So if you look at a problem, and sort of touching on the previous question where you say, what are you looking for in businesses? So generally, if you look at some of the most successful businesses in the world, or the most successful entrepreneurs in the world, there was a problem that they identified that was quite personal. So it might be a friction point that they have in their lives, their family may have it, their community may have it, and they start the business to try and solve that friction point. Now, that can be super important in the sense that if it's important to you, it's likely you're going to try a little bit harder. As when the chips get down, the chips are down, money isn't the only thing that's going to make your life better. You need to have something a little bit, more than just saying, I'm trying to make some money. I'm actually trying to solve a problem that's important to me, my community, etc. But in assessing that, and Hans spoke about product market fit, what may work in a community, in a region, in a country, may not necessarily translate into other markets. So when we talk about scalability, and a common mistake that we see is that just because it's important to you, it doesn't mean it will be important to someone else. There's a very good chance it will be, because humans, we're not as complex and special as we think we are. We actually have very, very similar challenges. Although, the scale and where you sit on Maslow's hierarchy of needs may differ. But the product market fit is really important to say, well, just because it works here doesn't mean it will work there. From our point of view, we focus on what can work in other markets, and why that's quite important. And Hans did speak a little bit around the opportunity in Africa, which is on the money. But as a market, Africa is not one market. It's multiple micro markets. And if you're really looking to scale and to become a large business with impact, you need to be able to play in markets that are not just your home market. So you can't just be, a Kenya business. You need to be an East African regional business. So Kenya has 50 million people. To become in East Africa, you've got 150 to 200 million people. That's a massive difference, right? From a population point of view, obviously Nigeria is quite large with roughly 200 million people, depending on who you ask. So it's a little bit of an anomaly. But then again, South Africa, which is, I think, the third largest economy in Africa, we only have 50 million people, but 17% of our population is economically active. So you say, well, if I really want to scale, I really want to become large, we're not talking about unicorn, we're just talking about a relevant company by international standards. You need to be addressing your product, or your solution needs to address a market larger than your home market. We're speaking a little bit around regional solutions. So let's not discount the fact that many African solutions have a place in the world sort of economy. So Hans spoke about, let's just say, copying and pasting. I know it's not what he's saying, but just for illustrative purposes, an international solution that worked in a similar emerging market, let's just say Southeast Asia. There are a few similarities there to some parts of Africa. Would work in Africa, it may and may not. From our point of view, we actually feel that the opportunity set is around local innovation, using the fact that they don't have access to traditional infrastructure, but have access to great technology to really leapfrog some of the solutions you may see internationally. So Hans spoke about fintech. I mean, M-Pesa, if you just, if you exclude the recent adoption, because it's only been in the last few years, of digital or crypto-based currencies, M-Pesa is the most successful digital currency in the world. I mean, they're doing like $16 billion worth of transactions.
We'll run out of time.
I think it's still good for time, so if we could carry on.
So probably to that point is that let's not just think about bringing opportunities that are, let's say, localized, or just copying and pasting international opportunities locally. It's around what can we innovate and how can we scale that regionally and internationally. And those are really the types of things that we look for.
Maybe Hans, if I can pose that same question to you. Are you specifically also?
I mean, I think I agree with what Ian said, but and I'm not saying that we're going to copy and paste, US business model into Africa. That's not going to work. But you also said, we humans have some common basic needs, right? Banking, health, etc. Right? So I still think that there are a lot of bit models out there internationally that are applicable in Africa. That's my view. If I can just take 2 seconds and just share, some kind of general aspects of raising funding quickly, right? And that's when we look at deals, we always start with a team. We always start with a team. You know, that's number one, number two, number three. And then we look after blue sky opportunities. We want to see that, you know, if this is successful, the team can actually grow across borders. They can also grow internationally, right? It's going to be a blue sky opportunity. And then we are not looking for exits. A lot of presentations has a slide saying, you know, how we're going to exit. You know, we you know, a great company we can always exit in a great company. We can either sell it to another investor, we can take it public, or whatever. But, you know, just focusing on building a great company, don't focus on doing exits. And another thing which I think is important is that we are not experts. We are generalists, right? And we are not business consultants. Some entrepreneurs come to us and they pitch and they say, "What do you think about this?" And we always have an opinion, but we are not the guys who are going to guide you to the right business plan. We are looking at business plans, we're looking at the team and say, wow, these guys have really something unique, right? But the day we started telling the entrepreneur what to do, when things go wrong, it's our problem. It's our responsibility, right? So obviously we are active owners when we have invested, but we really, when you come and present to venture capitalists, know exactly what you want to do. Right? We're not consultants that you can sit down and have a discussion of what you're going to do. And then the last thing is valuation. A lot of entrepreneurs are striving for getting some crazy valuation. And the risk is actually that you raise a too high valuation. And then when you're going to do your second round, you have to do a down round. And it's painful for everyone. And it's really hard to do, right? The guys who invested in the beginning, they feel they're not going to be very happy. And people are going to ask, why did you fail of keep maintaining your valuation? So don't reach for these super high valuations or you know, try to see, okay, how can I build a business from this valuation to the next valuation, which must be higher, right? That's my summary advice, right, to someone who's raising money.
Any add-ons to that question, Rob?
I'd just say, you know, there's boom and bust in the world. I look at a 10-year plan. It takes 10 years to build a brand, trust, a golf swing, and a business. So think through where is this going to be in 10 years? Build your business for 10 years. Don't think 1 or 2 years.
I mean, that's a good summary. To end off, I want to pose this question to each of you. I mean, you look at lots of deals every day, or I mean, on a monthly basis. What is one mistake that you keep seeing over and over that founders keep making that put you off immediately? Maybe, Ian, we can start with you.
Well, I mean, look, I spoke a little bit around making that assumption that because your solution is something that addresses you know, something that's important to you, that may be important to someone else. So we see that quite a bit where you haven't really done your research in terms of the addressable market, to Hans's point around product market fit. But I think I wouldn't really say put you off, because a big part of our role is to try and let's say coach some of the entrepreneurs who may make mistakes along the way, whether we've invested or not. So I wouldn't say we get put off too easily. We try where possible and help as we can. But I think, you know, Hans did chat on something which is quite topical around valuation. I think there's two things that probably are worth, you know, talking through there. Number one, not all investors are the same. So different investors will add different values to the companies. So as Rob said, he understands his skill set and he brings in partners who have complementary skills or skills that you know, it's just not really his area of expertise. So he's over his course of his career and his journey, he's realized that. So the same for an entrepreneur is to understand, well, what are you really good at? What are you not so good at? Because everyone has things that they're not so good at. And how do I find a partner who can help, let's say, plug those gaps? And that's something that often doesn't come through. So often we'll say, well, what do you want an investor for? And they'll say capital. And you say, okay, well, that's a pretty easy answer, but there must be something more to it. And then probably the final thing is to what Hans was saying in terms of valuation. It's not just about the price. So there are things, as we're talking about the right partners, but also there's many terms in there outside of price that can potentially trip you up down the line. And entrepreneurs often will get a little bit caught up in, well, I want to tell my friends that I just raised at this lofty valuation. We're not realizing that in actual fact, there's a few funny terms in there that you sort of overlooking.
Okay, we're running short of time, so I'll give you the last word. What is one thing that puts you off?
It's dilution and being quick to fire. On dilution, people get fussed about, oh, I want to stay at 51, or I had 100, now I've got whatever. It's irrelevant. 5% of a multi-billion-dollar business is worth more than 50% of a $10 million business. So don't worry about dilution. Focus on the business, focus on building a success. And the second is, even if you're loyal to someone, even if you love them, even if they're your ex-buddy or a founder and they have a stake, if they're not doing a good job, get rid of them, fire them, cut them loose. It's better to fail quickly than fail slowly. So make decisions quickly, pivot, be decisive.
I love that. That's a great way to end. It's better to fail quickly than fail slowly. We've discussed some key points that investors are looking for, and I've definitely learned a lot. Gentlemen, thank you so much for sharing your knowledge and experience with us. Thanks, everyone.
Thank you.